right, everybody. Welcome to episode 2 of the Knoxville Financial Q&A Show. I am your host, Paul.
I'm Brian.
And today we're answering 4 questions that you guys sent in. You sent in actually quite a bit more than we expected, which is great, but these have to do with taxes. And since tax season's coming up, we figured this would be the perfect opportunity to answer these questions. And so let's just get right into it. So Mark asked, how can high income earners reduce taxes legally?
All right. There's numerous ways. The biggest thing is just trying to figure out which ones impact your exact situation. So, one of the first ones would be...
Yeah, I mean, it's an easy one. Most financial advisors should be doing it anyway, but asset location is a big deal, and you hear a lot about asset allocation. You don't hear much about asset location. Look, asset location just means you're putting tax inefficient things like dividend paying stocks or whatever in let's say the traditional side of your portfolio where it's tax deferred. So you're not paying taxes on those dividends. And then you put your tax efficient equities that don't pay dividends essentially in your brokerage or individual account. This way there's not a whole bunch of taxes being generated.
Right, and then you also have things like tax loss harvesting, which is a way to offset gains. It doesn't really impact it when it comes to like income taxes per se, but it helps you when it comes time to take those gains.
It can reduce your income tax a little bit if you have, it's been a really good year and you have some really good gains.
Short term
for sure, and you want to at least mitigate or reduce some of those gains with just by doing simple tax loss harvesting. Basically, tax loss harvesting is selling things that have not done well to offset some of the gains that you have incurred that for the equities or whatever that have done well.
Yeah, but when it comes to some of the high income earners and places, really the biggest is going to be like for self-employed or business owners. Things like SEPs and things that allow you to basically have a separation of your business's contribution to your retirement and your contribution to retirement. A lot of the high income earning W-2s don't have very many places to hide. They can max out their 401ks, obviously. But kind of outside of that, you're very limited on what you can do. If you make over, $300,000 a year, you're pretty much out of luck when it comes to hiding outside it, in a W-2 at least. I'm trying to think of other ways that really impact.
Well, one of them you just said, max out your 401k if you can. If you're a high income earner, for 2026. It's $24,500 per year, and the good thing is over age 50, there's an additional $8,000 catch-up provision.
Yeah, and between 60 and 63, you have the ability to do the super catch-up contributions, which is new. So definitely take advantage of that if you fall between the 60 and 63 years old.
And that's $11,250. So if you're between 60 and 63, you can basically take $35,750 out of your taxable income.
Well, what about deferred comp? I mean, we think about sometimes organizations allow deferred compensation that can impact you or help. I'm trying to think if there's any other unique situations that people should be aware of.
I mean, without getting too far into the weeds, like things like cash balance plans and stuff like that.
Cash balance plan is a great one.
Yeah.
Gotta have it, but
yeah.
That's not provided to everybody. That's
like... We're being very general here, guys, and I think it's important that we make a quick disclosure that says, if you take any advice or suggestions that we give you as tax advice, consult your CPA.
We are not CPAs.
Okay, consult your CPA, please. Maxing out the 401k, like we already talked about.
If they're a business owner, take advantage of an SEP, simple, or individual 401k.
Health savings account, that's another good way to reduce taxes. It's not a huge amount, but they're good anyway, regardless, because you get the triple tax benefit, essentially, where it's deductible, your contribution is deductible, it grows tax-free, and it comes out tax-free for qualified medical expenses.
Well, and when you think about it too, there's lots of loopholes when it comes to that. I should say, I use that term loosely. It's not really a loophole, but there's no law written that requires you to take your withdrawals from an HSA for healthcare expenses in the same year. So essentially, you could stockpile those receipts for your health expenses and defer your withdrawals till after retirement or close to retirement, and then take your withdrawals, which is also a unique example of how you can take advantage of it.
All right, question number 2. Amy asked, this one might get heated here. Amy asked, are backdoor Roth IRAs worth it? The reason I said that was because Brian's in the middle of trying to do one right now, and we're having a little bit of issues from account opening side of things. But anyway, I would say in non-financial terms, and Brian might agree or disagree with me, if you're an organized, excellent record keeper kind of person, yes. If you're not organized and you don't keep good records, I would probably avoid them.
Yeah, I would probably agree with that. The reality is they could be very, very beneficial, especially when you're in the high earning situation. Deferring income is great, but it leads to the compounding problem of lots of what we call qualified money, which is money that is pre-tax. And when you have a very, very, very large nest egg at 60, 65 in retirement age that you have to worry about withdrawing, if you accumulate too much, which is a good problem to have, trying to avoid RMDs become a significant challenge. So would a backdoor Roth be worth it? Yes. There is some caveats to that, which is what he was talking about. I'll expand on. You have to make sure you have your ducks in a row. You can't have any IRA money outside of your 401k because that has to be converted first. So if you're in a situation where you have the high income earning potential and you really want to take advantage of, you need to be good at record keeping, become really good friends with your CPA and or tax attorney, because you will get to meet with them at least once a year and document everything to make sure that you're not going to, or if you get audited, that you're not going to be caught with your pants down, so to speak. But are they worth it? Sure. I think it's a double-edged sword, but yes. Pam asked, how do I create a tax-efficient portfolio?
Basically, we kind of answered that already in question 1, but a tax-efficient portfolio would be asset location. For sure.
Low turnover.
Low turnover.
Utilize municipal bonds. Municipal bonds, I think, are probably one of the best kept secrets, especially for people that have high income taxes. And thankfully, in the state of Tennessee, we used to have the hall tax, which we don't have anymore, which, yay. But, yeah, I think the location is dividends. If you have significant dividends, you can get hit there. There's lots of little things, but yes, the most tax efficient municipal bonds, stuff that has low turnover, stuff that isn't dividend intensive. Pam,
if your advisor, if you have an advisor, like if your advisor is not doing these things for you already, then you might want to ask for or search around for a different advisor, whether it's us or somebody else. All right, final question here. John asked, Roth or traditional 401k at 120k income?
I think you could go either way on that. That's right there at that line. It depends on if you're filing single or if you're filing married joint. But I'd say that's right there along that income level of, the ability to compound your deferred, taxes could be significantly impacted. The downside is we don't have a crystal ball, so we don't know what tax situations look like 10, 20, 30 years down the road. Could be more, could be less. So,
well, the other issue here is we don't know John. None of these questions came from our current clients. It was just people that saw the first video. So we don't know John's situation. I would say like an easy answer to that would be, if John is in a position where he's been at a job for a while and he doesn't expect to have jump up in a tax bracket before he retires, then he might want to just go for the traditional.
Sure.
Right? And then after he retires, he could potentially be in a lower tax bracket where you might want to consider Roth conversions. By the way, we're going to do a whole episode just on Roth conversions pretty soon. So, and then if you're just starting out and you're in a low tax bracket, for sure, I would contribute to the Roth 401k first.
Absolutely. And you're still going to get stuck with some pre-tax traditional money no matter what, because most matching is going to go towards the traditional or pre-tax side anyway. So if you contribute to your Roth 401k, the match that your employer contributes is going to be pre-tax.
That's correct. So we just answered the 4 questions that you guys sent in. We appreciate it very much. Continue to do so. And I hope there was some value to this one. And we just kind of just blew right through this, it seems like, right? But yeah, so if you have some questions that you guys want answered, like I said, there was some others that you sent in that we haven't answered yet because we just wanted to do ones that had to do with taxes since April 15th is coming up. So send them in, info@iws.one, or the page that we host these videos on our website also has a contact us form. So either way is fine. You can also just call the office, 865-342-7766. With that,
Signing off
again. Thanks for watching.